Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The secret of life is honesty and fair dealing. If you can fake that, you've got it made. Groucho Marx. Life is what happens to you while you're busy making other plans. John Lennon. The trouble with the rat race is that even if you win, you're still a rat. Lily Tomlin. The meek shall inherit the earth, but not its mineral rights. J. Paul Getty. In archaeology you uncover the unknown. In diplomacy you cover the known. Thomas Pickering.
If you think you're buying Taiwan equities, you're mostly buying semiconductors in a different font. 85% tech weight. South Korea and the Netherlands aren't far behind, same trade, different geography. The US looks diversified at 33% until you sneak in communication services, then it's basically one big growth bet wearing multiple outfits. Here's a catch. When liquidity is loose, this concentration feels like genius. When rates rise, it starts looking like synchronized swimming without the music. Globally, we are not at .com extremes yet, but we are unusually concentrated in one idea. The future equals tech. That works until everyone owns the same future. While headlines worry about deficits, the world is quietly doing the opposite. Buying more US debt. Foreign holdings just hit a record $9.5 trillion, and most of it is long term. That's not trading, it's commitment. Japan keeps showing up like a disciplined SIP investor, 13 buys in 14 months, because US yields still beat what's on offer at home. The UK is adding too. China trimming but not exactly storming the exit. Here's the punchline. Everyone complains about US borrowing and then funds it anyway. India is not just growing, it's minting wealth at scale. Ultra-rich individuals jumped 63% in 5 years, closing in on 20,000 people with over $30 million each. That's not luck, that's a cocktail of booming markets, tech leverage, and capital finding fewer, bigger winners. But here's the twist. While the number of millionaires is rising fast, the distance between them and everyone else might be rising faster. This isn't just prosperity, it's concentration with good public relations. After 6 straight months in the red, India's FDI just flipped back to positive $4.6 billion. Not a surge, but a clear change in direction. What's doing the heavy lifting? Classic mix, tech, finance and manufacturing, with global giants still writing checks despite noisy geopolitics. Meanwhile, FPIs are heading for the exits, but FDI is a patient capital in the room. It does not panic, it plans. So the signal here isn't money rushing in, it's long-term money never really left. India's manufacturing PMI is back at 55.9, a 3-year high. Orders are rising, jobs are picking up, and inventories are building like someone expects a busy season ahead. But here's the nuance. This may not be pure demand, it could be front-loading. Companies and consumers rushing in before prices climb further. Input costs are rising faster than output prices, which means margins are getting quietly squeezed, while headline numbers look great. So yes, factories are humming, but part of that hum might be buy now before it gets too expensive. Just as global debt was catching its breath post-COVID, geopolitics said not so fast. 2 years later, deficits are widening and borrowing costs are rising, a dangerous combination. The US and Japan are already carrying the heaviest debt loads, and now higher yields mean refinancing the debt just got more expensive. Emerging markets hit from both sides, higher energy bills and tighter financing. Here's the real issue. Debt isn't exploding overnight. It's compounding quietly. And when interest rates rise, that snowball doesn't melt, it accelerates downhill.